Okay, hello, welcome everyone. This is our Clearly Essential team webinar for November 2016, but this is going to be a really great timeless training on some tax tips. So I'm Crystal Garvin and I'm here with Brenda Schans, and Brenda and I met almost 12 years ago in Tulsa, Oklahoma. We attended church together. We were both in a different network marketing business at the time, but on different teams, so we were sidelines. And we were in different places in life. I didn't have kids yet, and she did. And but we connected some at church, and then we were Facebook friends, and just kind of sporadically would stay in touch some. And I actually noticed that she was taking a trip to Tanzania for her previous job. And I just messaged her and said, "Oh, that's so cool, because I've been to Tanzania twice, and we have missionary friends there. And what are you going there for?" So she explained about her trip. And then she asked me, "So what are you doing now?" And that gave me an opportunity to share what I was doing with doTERRA. My business was probably less than a year old at that point. And so she came on board a couple years ago after using some oils for a while. And she hosted a class that I was able to join online, and did this exact thing we're doing here with webcams. And I was in her living room on webcam, and she had some people gathered, and she was a lot like me. She went back and forth on, well, I don't know if I want to do this as a business. I love the oils, for several months. And then she jumped in, and she's now a silver on our team, and she lives in Ohio. So I'll let you introduce yourself, Brenda, as far as your background when it comes to why you're talking to us about taxes today.
Oh, thank you. I am also a CPA, and I have had my CPA license for 16 years. I worked public accounting until I had my babies, and then I started staying home with them, but have continued to do tax returns, and I do them actually just out of my home now during tax season. Just to build a client base with accounting. So I have been in the accounting world for a long time.
Okay, great. Well, I'm excited about this topic. You can get ready to share your PowerPoint, but the reason I wanted to do this, one, this is good timing because we're getting to the end of the year, and it's a good time to start thinking about gathering your receipts for the year, knowing what your expenses were for the year. But I'm surprised at how many people don't think about taxes when they start their new business. And probably if I hadn't had a business previously, I wouldn't have either. But I thought, we really need some training on this topic. We really need for people to understand what does and doesn't work, and to be thinking ahead so that it's not April and you're realizing, oh, I have things I could claim and I need to find receipts and I don't know what I'm doing. And you didn't write down mileage for the whole year, so you can't even count that, which is a great deduction if you're traveling a lot for classes and things. So I wanted to present this toward the end of the year and really give you some food for thought for gathering whatever you've done for 2016. And then for future years, I think this will be really helpful for all of us to be able to share with our team members early on when they start a business, to say, start thinking about your taxes now. Because this is a huge benefit in the beginning when you're possibly having deductions that match your expenses, or as you get farther along, you need to be saving and setting aside money so you're not hit with a huge tax bill when you're profiting more and being surprised, like, oh, I forgot I had to pay taxes and I've got to come up with thousands of dollars. So you don't want to be in that position either. So that's why we're doing this today. And I will I think we're going to turn off our videos and let you see the full screen here with the PowerPoint, but we'll still be here by audio, and we'll be interacting back and forth. We'll let Brenda present her information, and I'll share some things about what I've learned after doing this for, I've been doing network marketing in some form for 11 years. So I've been doing my own taxes and then having a professional help me with taxes during that time. Related to a network marketing business. So I'll share some of my experience as well.
Thank you. And I can't reiterate enough how important it is to start keeping track of all of your records from the very beginning. It is very tricky if you wait until the end of the year to try to figure out everything and try to go back and figure out what your miles are, and you're looking at your calendar, you're going to miss things, and you're going to end up missing deductions, which is going to be more money that you get to pay in taxes. So it's really important. So that's a really good point. Okay, so we ready to get started, Crystal?
Yep, take it away.
All right, so I'm going to talk mostly about when you're actually doing doTERRA as a business. And the IRS looks at income in really two ways when we're talking about, specifically with your doTERRA. They're either looking that you're building a business or that it's a hobby. And how you record those and how you report those to the IRS are different. One of the main differences is as a hobby, you just put that in as other income, and then you can have deductions up to the amount of money that you brought in, up to your income. So you're not going to have any type of a loss. You can't show that you lost money in the business. You can only basically show that you had a break even. So it's not subject to self-employment tax. So that's the benefit of being a hobby, but you're not going to ever show a loss. And a hobby is, maybe you're just like wanting to make some little items, and, sell them every once in a while. And you're not you're not able to show the IRS that you have a calendar, that you're really doing a business, that you're talking to people on a consistent basis, that you're doing classes. So this is something that, if you were audited, the IRS could question you on. So you just want to make sure, if you're saying that you're in business with doTERRA, that you are truly working this as a business, and that you have the records and the calendar to show that you're intentional about your business and it's not just a hobby. So on a business would mean that you're going to do this on your Schedule C of your personal tax return if you're a sole proprietor. You're able to expense fully deduct all of your expenses, and we're going to talk about that in a little bit, and that you are able to have the losses offset income or carried forward, and you are subject to self-employment tax. So that's a big thing to remember as well. So we're going to talk first about what the income is. So your business income is going to be the money that you make from the items that you sell or the services that you provide. And it's also going to be the money that you receive from doTERRA for your fast start bonus and your unilevel commission and your retail commission and all of the different ways that we make money through doTERRA. So doTERRA is going to give you a 1099 for what you receive from them. But if you, buy product and then you sell them maybe at a vendor event, or you sell them just to someone retail and it's not recorded, then that's also going to be a part of sales income on your Schedule C. And they're not going to know about that if you don't tell them, but you are required to report all the income that you make, not just what's on that 1099. So then the second part is your expenses. And this is definitely the part that a lot of people, they miss out on a lot of expenses. And this is one plug that I'm going to make to have you, to really recommend that you have a CPA do your tax return. Because I know when I have done someone's taxes after they've done it, on their own, they've missed a lot of deductions because they just don't know. And you don't know what you don't know. So I do really recommend that you have someone prepare your taxes, because when you don't do deductions, then you're going to end up paying more tax. And I'm all about keeping more in my pocket than paying it to the IRS. So Crystal, do you agree with that?
Yeah, I actually can weigh in on that, because we did our own taxes for many years, and we never hired a professional to help us until the taxes for 2015. So just last year was our first time that we had used a CPA, and we realized we should have done it at least a year sooner, because we paid so much more in taxes the year before, and he was able to help us set up, LLC and do things where we're filing as S Corp, which, we can get into a little bit, and it saved us so much with the self-employment tax versus what we had done the year before. Plus, like you said, we thought we had a pretty good handle on deductions. Like I said, I'd been doing my own taxes as a network marketer for 9, 10 years at that point. So I thought I had a pretty good handle on it, but there were some things he offered very valuable perspective on. And definitely the amount that I ended up paying the professional more than offset the amount I saved on my taxes. So I think you can do it if you're, proficient in this and have done it on your own and feel like you have a good handle on it, but it can be really overwhelming, and it gets more and more complicated the more profitable your business becomes. So I just feel like it's good to start working with someone earlier on, and they can work with you as your business grows. As long as you're getting someone, I would say, who has at least some experience with network marketing, because there are some different types of situations that are unique to direct sales and network marketing.
Yeah, good point. Okay, so I'm going to go ahead and I'm going to talk about the expenses and some of the things that you can write off. It's not, this is not an inclusive that's every single thing that you can write off, but these are just some of the common things that you will have for your business. You can have a prorated portion of your cell phone and internet, and be realistic. Some people want to write off 100%, but your internet is used for so many other things in the home. So, decide on a percentage. How much of your cell phone and internet are you using for your business? The perfect world for cell phone would be that you have, one phone's designated for business and one is for, personal. It used to be that we'd have a home phone and you couldn't deduct that main phone. But, I know most of us, we just have a cell phone. So I normally will prorate, kind of look through and, how much am I talking in a day and, using email for my business and things like that on my phone, and kind of determine what does a typical day look like. And I'll write off, that portion of the cell phone. So allowing personal use, which, your personal expenses, personal use are not deductible. And, those are, when you're writing off these, large amounts for some of these things, it's a flag to the IRS. So, you're able to have phone and internet. Just have it be reasonable. Second thing is mileage. And this is a really big deal because I know for me, I do a lot of one-on-ones and classes and, networking and appointments. And there's a lot of mileage that I have for my business. But I can't just say, I'm just going to take half of my miles. I have to have it documented in either a mileage book from Office Max or Staples, or an app that you can prove the miles that you've driven. You can have down, this is where I went. This is, what it was for. This is the meeting that I had. So you have to be able to substantiate those records. Each year, the standard mileage rate changes. So for 2016, it's 54 cents per mile. It went down from 2015, but each year it does vary a little bit. So you do want to make sure that you know what that standard mileage rate is. You can do your actual expenses, but then you would have to prorate your actual expenses based on, business use versus personal use. I don't recommend it. Most times, you're going to get a lot more value, a lot more deductions by just taking a standard mileage rate. And that way you're not having to figure out, the percentage that you're driving business, the percentage that you're driving personal. You know exactly and can substantiate very easily when you keep track of your miles. So, and that 54 cents basically incorporates the cost of gas and the wear and tear on your vehicle and the repairs and service on your vehicle. So they take that amount and they kind of have figured out based on the economy of where it is that that's about the cost per mile on your car. So they do, try to give us a pretty fair deduction on that. But I do just want to say the key is keeping records. And Crystal's really, really good at that. Take a lesson from her. She gets in the car and that mileage book is out. So she can inspire you, because sometimes we all can forget, me included.
Yeah, it's a habit for me. It's just automatically I get in and I see my notebook and think, is this a business trip? Yes or no? If it is, I grab it and I write it down. A lot of people are using Mileage IQ or another app like that. Mm-hmm. I had already ingrained in myself a habit to write it down, and that's just what works for me. But I know there's a lot of great apps out there that you could do it just automatically. And You just have to, every time you drive or, catch up maybe after a week or a month, go back and designate, was this personal, was this business, and make a note if it was business where you went.
Right.
So, yeah.
Yeah. And it's good to know, who you met with. If you, are going to a coffee shop, who did you meet with, so you can, have the validity there with that as well. And one thing, when you're using an app, it does use a lot of battery. So apps are great, but I don't like it eating up my battery. So that
was my problem I tried an app for a little while and it messed up a couple times. Like it logged something it wasn't supposed to, or didn't log something it was supposed to. And I didn't realize it wasn't running or whatever, or it is running and I don't want it to be because it's eating up battery and data and that kind of thing. So just do what works for you though. If I were starting it out now and had never gotten in the habit of writing it down, I would probably do the app. So I didn't have to think about it as much.
Yeah, that's a good point. Okay, next thing is office expenses, rent, computer costs, and other supplies. So, if you go and buy ink, really all that I personally print is really for doTERRA. I rarely print personal things. So the ink for your printer, even if you need a printer, if you have paper, other supplies that you need, if you have a separate place that you rent for events, or maybe you even have a permanent place that you rent for your team, that would be a rental expense that you can write off. Computer costs. So computers, if you purchase a computer, you are able to count that as a business deduction. But if it's not used 100% for your business, if you're going to use it for some personal things, then you would really want to prorate and write off a portion of the computer, but not 100%. Because you have to, if in the case of an audit, be able to substantiate your expenses and how you came to that cost. And so, if they look on your computer and they find that you're using it for personal things and you're editing pictures and other things like that, they're kind of really, that would, bring some question. So just make sure that you're doing what's reasonable. And then other supplies. So this would be, things for samples, like the little sample drams or rollers, your class in a box kits, that have your flyers, or anything else like that would be supplies. Now, clothing is not deductible. So if you, go and get, some purple pants because you want to match the doTERRA look, that's just a personal expense. So you cannot write off that, and you can't write off the dry cleaning either. So that's personal. A lot of people think they can. And you can't write off like highlight for your hair or manicure for your nails because you want to look good for a class. So we would love to do that, but those are not expenses that are able to be deducted. Food for promotional events. So if you have a class and you go and buy, a box of brownies and make the peppermint brownies, you are able to write off the food for that brownie box and, those supplies at 100%. So make sure you're keeping track of that. And then your cost of goods sold. So this would be, the inventory that you have, and the things that are going, what you're purchasing, what you have left, you calculate your cost of goods sold. So that would be something that you would also need. And that's more basically for someone who is making products with their oils. So if you're making, salves or lip balms or things like that, then there is a calculation that basically you want to either look at how to do or have an accountant help you with to figure out what that ending cost of goods sold number is. Meals and entertainment. So this, you can deduct them, but you can only deduct 50%. So they do not allow 100% of meals and entertainment. They do, like I said, on the food for promotional events, but if it's, where you're going and you're meeting someone for lunch, or you're at convention and you're, going out, with your team for a meal, you can only write off 50%. So this is really important that you need to have records of who, what, where, when, why. So when did you go, where, what were you doing? Was it a one-on-one? Was it a team event? who were you with? Those are just things you can either write them on your receipt. You can have them in your calendar, to be able to look back at that date to see, who you were with, or if you're in QuickBooks or Quicken, to have that information in there. So it's really important that you're saving your receipts on all of these different expenses and you have those records. I don't recommend sticking everything in a shoebox and then at the end of the year having your accountant go through and try to total everything. Because when you have someone do your taxes, you're paying them normally by the time. And so it's better to keep track of all of these expenses along, throughout the year. And this also gives you a better handle of where you are in your business.
Mm-hmm. There are some people who they do use apps where you can take pictures of the receipts too.
Yes.
So I don't do that. I keep the actual receipts, but you will notice a lot of the receipts nowadays, within a few months, the print will be worn off. It's the type of print and paper that a lot of restaurants use. Mm-hmm. And so if you're not keeping track of it in QuickBooks or taking pictures and you're using the app that's specifically for keeping track of receipts, you have pictures, one or the other, your records could be lost if you are just throwing things in a shoebox and thinking, I'll just, sort it out at the end of the year and calculate. You'll be surprised some of your receipts will be blank pieces of paper.
Yeah, good point. And it is good to put things, to make a copy of them. It's easier, less paper, and that way you can look back. Travel is also another thing that can be deducted, and that would be things like convention costs. So your airfare to get out to Salt Lake City, your hotel while you're there, if you're using Uber or something while you're there to get around, those can all be deductible expenses for travel. Also, if you're doing out-of-town classes or other events, you'd either do mileage, or if you're doing airfare, you'd write off your airfare or a rental car. So those are some of the types of expenses that would go along with travel. Now, any meals that you would have even when out of town are going to be deductible at the 50%. So it doesn't change just because of travel. So you do want to keep your meals and entertainment separate from your travel. And you want to make sure that your intention when you travel is, like, say, for example, you're going to Salt Lake City for a convention. You want to make sure that your purpose and intention is for convention, and the majority of your time is spent on business convention. So if you go out to Salt Lake City, and you have 3 days of convention, and you want to stay an extra day for personal sightseeing, that's completely fine, and you're still able to write off 100% of the airfare because you were there for business. But when you go to, maybe you want to go sightseeing, there's a fee for something that's personal, that would not be deductible. So you would want to make sure that you're pulling your personal expenses out of that equation, of your deductions, and you're only deducting your business expenses when traveling. Now, if you say go to the beach for summer vacation and you're there for a week and maybe you do a class for a friend that's there, you cannot write off all of your travel and all of your lodging, at the beach when you did a 2-hour class and you were there for a week. So you have to be able to substantiate and show that your intention of being at that, out of town location was business. Now you can write off the mileage going to that one class, but you cannot write off a full, vacation because you handed out a couple samples or did a class. So make sure that the motive and intention is there for business. And that can be kind of misleading for some people, and they can think, oh, I can write off all these great things. It's only business. So, when you start having unreasonable expenses, it really is a flag to the IRS for an audit, and no one wants to go through an audit. So,
right. And then there is an audit guide for the auditors, and they have some very specific things to look at. So I know a lot of times people will try to justify, well, I gave out samples while I was on this trip for the wedding, for family wedding or whatever, so I should be able to count it. Or for different expenses. They'll try to justify it, but just keep in mind there are specific rules. No matter how you think you can justify something, you've really got to go on the trip with the intention of doing business primarily. And that was the reason that you even booked the trip. And so if you've got emails from, your cousin and sister, and they say, let's do some classes, great. And then you happen to also do some sightseeing, like Brenda said earlier, or, spend time with family, that's fine. But the intention, why you booked the trip on those dates, was to go do some classes and meetings and things like that. That has to be, you would have to actually prove that and show the communication you had when scheduling those things if you were audited.
Yes, correct. So a lot of people, it can be really misleading. And, I've even heard some people say like, oh, you should do network marketing because you get to write off everything. And that's really not true. So just, make sure that when you're writing off things, are their business. All right, education and library for personal development. So, when you're buying books for personal development, you go buy, your How to Influence People by John Maxwell, or those types of books, not your, romance novels. I'm talking like personal development books and different items. Those are something that you can deduct. So that, things that you're doing to educate yourself to further you in your business. So if I want to go and do an aroma touch class, I can write that off because that is education to further, me and my business. So that's important to know because, personal development's a pretty big part of our business. And so those are able to be deductible. Just make sure you have receipts. And then dues and subscriptions. If maybe you do Lead Train or another type of subscription service, those are all able to be deducted on, from your income, as long as you substantiate that it is a business expense. So I know there are, even some things like I know Dr. Axe has like a whole education type thing, and I think it's subscription based, and those things are able to be deducted if you can show that they're going to benefit your essential oil doTERRA business. So just make sure that you have those kind of records and that kind of proof to show that. And then this one is I saved the best one for last. So your LRP, there's a lot of different viewpoints on this. The viewpoint can be that you don't write any of it off because it's personal use, because we're a product of the product. Or you write all of it off because doTERRA requires that order, and because they require that, order, then you should be able to write it off. And I like that viewpoint, but right off. But there is a line on your Schedule C that actually says, like, deduct your product use for personal use. And so it's there because they don't want you to deduct what is used personally just for you. Like if I'm buying my protein shake, the trim shake from doTERRA, and I'm eating it every day in a shake, I'm really like, if I don't buy it from doTERRA, I would go buy it at the grocery store and it's not deductible there. So I do, like, there are things that I like to have, for classes. Like I use my peppermint and my lemon, for classes all the time. I am doing samples, and it's good to have a records of who you gave the samples to and what you gave them, so you can substantiate that, this portion of my oils was used for actually promoting my business. So you really want to prorate your LRP to write off a portion of it, because I know that not 100% of my LRP is used personally. It really kind of gets intermingled. And I personally don't have separate bottles for samples and separate bottles for myself. That's a really great goal to have. But at the beginning, you don't, well, and even, I think until you get to where you're like, have a really good base of duplicates, you're going to have them intermingled. And that's okay. The IRS doesn't demand that you keep them separate. Just make sure that you figure out a portion. Okay, if you're using these oils every day and you're making these rollers for yourself, how many drops are you using personally? And figure out a portion. If you're using the supplements every month, those really are a personal expense for supplements. So you can have them be vitamin expense for your personal, just personal records, but it's not a business expense because it's really for you and your health. And if you weren't doing the business, I'd still take the vitamins and wouldn't be able to write them off. And so you have to really look at it that way too. Like, I'd still be taking those vitamins. It's a personal expense. If I buy the class in a box, in my LRP, the class in a box is going to be fully deductible because that's used for business. If I'm buying, oils to give at a vendor event or at my class, that's, deducted at 100%. Or maybe, someone says, hey, when you get a chance, can you, order a lemon, put a lemon in your order, and, they buy that lemon at the wholesale. They just ask you to do it because they just need that one item. You're able to deduct that as well. But just, keep in mind that you do need to pull out that, the personal use portion. And this is probably the biggest discussed item in deductions for network marketing, and probably one of the biggest flags as well.
Yeah. Yeah. And this is something I've consulted different people about because a lot of team members will get argumentative about it and say, well, doTERRA requires it, so I'm going to deduct it. I'm going to deduct it 100%. I'm only ordering that much because I have to get commission. And that is not how the IRS sees it. So no matter how well you think you can justify deducting it at 100%, if you're using any of it strictly for yourself to consume, then it is not a business expense. So just like Brenda said, the things that you consume personally and use in your home, like the vitamins is a great example. You need to have that part set aside for personal, and you can do a percentage. So my CPA actually recommended really tracking it very well for about 6 months, coming up with what percentage or even what dollar amount, we typically spend for ourselves personally, and then just going forward with that amount as a good baseline. So you can do it a number of different ways, but just differentiate somehow. Some people have 2 separate LRPs set up and they use 2 different cards so that they don't have to mess with trying to figure out a percentage. And they use one card only for their personal and one card is all business. And they do 2 separate LRPs. And honestly, shipping is so cheap now that you could do that easily and it could save you the hassle. But some way or another, you need to differentiate, and you need to know that writing off 100% of everything you purchase from the company is a big red flag in network marketing businesses in general. And you don't, like Brenda said, want to have to go through an audit. So just be realistic and honest about what you're just consuming or using for yourself. And if you do have a completely separate set of oils that you can build up to having those just for taking to classes and using for samples, that's a great way, because there's one set just for your personal use and another. But like Brenda said, that'll take some time to build up to.
Yeah. But that is really the goal, is to keep your records completely separate. And I mean, if the sooner you can do that, the simpler that your accounting side of your business will be, because that you really want it to be separate. Where my husband works, he's at a corporation, everything's separate there. Like, they don't have personal stuff intermingled. So we have a real business. And so that is the goal, is to have things completely separate. So, lean towards that. Obviously, things like cell phone, we're not going to carry 2 cell phones. So there's a couple of things, that you're not going to have separate. But that is a really great goal, is to really start to separate your expenses, to separate your credit cards and your bank accounts and your things like that. So now I do want to, back up. We talked, briefly at the beginning about hobby versus business. And so you do want, they want to be seeing some profit. So if you're showing a loss every single year, then they really start to question, like, are they really doing this as a business, or is this just a hobby? So they like to see that you're profitable at least 3 out of 5 years. And the burden of the proof that the activity is a hobby is actually on the IRS. So they would have to prove that it's just a hobby. But if they come to you and you have a loss for maybe 3 years and you're not profitable 3, but you have a calendar and you have activity and you can show all that you're doing, then you can substantiate and validate that, yes, I am doing a business, but maybe it's just not, where I want it to be, or my computer broke and all these things and I had to replace, costs that ate up the profit. I would tell you as well, though, at the end of the year, one of the things that an accountant recommends is, if at the end of the year you have a lot of profit and you say you need a new computer, buy it before December 31st and write that off.
Yeah.
Not pay as much taxes, or maybe at the end of the year you're really low on your oils, for your samples. You could, replenish some of those oils and have those write-offs before or by December 31st, really. So it is okay, if you're looking, that means you have to keep track through the year and you know where you stand and you know what your net income or net loss is. So, but if you see a big net income, spend it, really. It's not bad.
Yeah. And that's one reason a lot of people do quarterly taxes, is you're keeping it throughout. I mean, there's a point when you're required to do that as well, but if you are keeping track throughout the year and you see that you need to have an expense before the end of the year, that's not, like she said, it's not a bad thing. That's something that a lot of smart business people do. And as far as the hobby versus business thing, there were a couple of cases that we listened to another CPA's webinar, and he had talked about how the IRS does have to prove that you've shown a loss. It is a hobby. You can't claim it as a business. They have to prove that. But if you are actually aiming to make it a profitable business, and that just hasn't happened yet, and you have records to show, then you're going to win that. That's just, it's not that you have to be a profitable business person. You just have to have records that show you're doing it as a business, and not just using, because this is something that a lot of people do, believe it or not. They will set up a network marketing business just to be able to use that for deductions. And they're not really aiming to make a profit. They just want to go to the meetings. They just want the education. They just want to be able to write off travel or mileage to attend meetings. They like the social aspect, for example, of being part of the team. So they have no intention of actually making a profit. And that's something that they would say, okay, fine, you can do that, but you have to classify it as a hobby and you cannot show a loss.
Yes, good point.
And and just since I'm mentioning it now, before I forget, there is a Facebook group. If you want to join it, you're welcome to. Or it's not actually a group, it's a page you can just like, that another CPA set up, and he's also in doTERRA, and it's just essential oil business tax tips. So you can ask questions there. You can also watch his webinar. That was something that I did recently, just to kind of get prepared for any topics that might come up as we were discussing this today.
Yeah, it was good, informative as well. Okay, so let's go to the next subject, and this will be brief. It's assets and depreciation. So for most things that we talked about, you're going to have an expense, but an asset is something that has a useful life that extends beyond the current year. So it excludes inventory, even if you have that on hand, more than a year, but that's going to look more like a computer, or maybe you have furniture in a place that you've rented. So those are things that typically are going to last more than a year, and you really need to have a threshold. Newer IRS regulation actually is that if you have something that's $500 or more, then you would need to depreciate it. You'd have to capitalize it as an asset and depreciate it. If it's less than $500, you can expense it. So if your computer is more than $500, you're going to want to classify that as an asset. If it's business only, then you would capitalize 100% of it. If not, prorate it. Maybe you use your computer about 80%, 75, 80% business. Then you would take that portion of it and capitalize it. And then you would depreciate it over, you'd find the useful life. So typically it's 5 years for computers, 7 years for furniture. and then you would depreciate the tangible assets, or maybe you have startup costs that would be amortized. I hate that word. And you would do that for an intangible asset. Now, if you have, if at the end of the year you have a net income, you are able to, it's called a Section 179, and you can depreciate the full amount of the computer. So that is allowable. And that's something that you would be able to see when preparing your tax return or having someone do it. But just keep in mind that things that are over $500 that are not like travel, but things like equipment, furniture, things like that, you would need to capitalize those. All right, and then we're going to go to another topic that's a fun one, and that is home office. And this is something that is a really great benefit of having a network marketing business, because most of us work in our home. But this is one of those areas that is probably one of the biggest red flags for the IRS as well. So when we are talking about a home office and writing off the home office, you have to be able to show that the place in your home that you consider an office that you're writing off is used exclusively for your doTERRA business. So they would be able to come in and look at my space and see that it's my desk and all my doTERRA stuff, and that they wouldn't have a question. You know, if it's in the middle of my living room, it's not exclusively for business. So it needs to be a place that's exclusively used for business. That's like the really big key when you're talking about a home office. So the regular method is, which is on the right side of the screen, is going to be, you're going to determine your square footage of your office and the square footage of your home, and you're going to figure out the percentage of your home that's used for business. And it's going to be actual expenses determined and records maintained. And this is where you would actually depreciate a deduction for a portion of the home used for business. But remember, if you do that, when you sell your home, you have to recapture the amount that was depreciated. So for a lot of people, it is a pain and not something that they want to do. It's not something I want to bother with, because my office space isn't big enough to really even deal with the headache of doing that. You would also have your, home-related items. Some of them would be direct expenses. Like if I paint my office, that's a direct expense. Some of them are going to be your real estate taxes and your mortgage interest. That a portion would be a business use of home deduction, and then the rest would go over to your Schedule A, which is for your itemized deductions. And so you're able to take a portion of all those expenses and deduct them. It can be kind of a pain for a lot of people, and there is a limitation to it. The other option, and this is actually newer, this has come about in the last couple of years, is the Simplified Option, which is a standard $5 per square foot used to determine your home business deduction. You don't do depreciation. You are able to claim your home-related itemized deductions in full on Schedule A. You're not having to recapture depreciation. So it just really simplifies and gives a lot less of a flag to the IRS. So for most people, I really encourage them to do the Simplified Option. On the regular option, I will say there are things that you can't really write off. And like if you're doing a repair in your kid's bedroom, you can't count that as home repairs and take a portion of it and deduct it for your doTERRA business. It has to be things that are like done in that office, or as a whole, like a new furnace, because that's going to affect your office spaces. So for most people, the Simplified Option is really going to be the option that I recommend. Do you take that?
Well, I know, I never have actually. I've never had a home where I had enough space to have a single use for my business only. So we just never did that. But that is a goal when we have a house again.
Yeah.
Have a specified place just for me to have an office. so that we can do that. And I would definitely do the simplified option, unless the only exception would be if there's a really large expense, like your whole heating and air unit has to be replaced, and it's a really large expense in that percentage. So typically I think your office space is 5 to 15% of your home or something like that. That could be worthwhile, but again, it would be if a professional were helping me. I wouldn't want to have to try to make sure I hit everything like real estate and mortgage interests and all of that without having some help.
Right. Absolutely. And just some things, if you do the regular method, you can do insurance, your utilities, you can do painting and flooring for your office, or, an entranceway even. You can deduct a portion of that. You can do, repairs and maintenance, cleaning, snow shoveling if you're having events or clients over. So if you're just wanting to, shovel the snow so you don't have to do it, but you have no one coming over for business, that's not deductible. And no lawn care and no room painting, if it's just general in your home, it's really more specific for your office. So, and that, if you're painting your office, you can actually take 100% of that because that's really truly just for your office. But those are just some guides on your home office. You really want to talk to an accountant for that because that can get pretty confusing. Okay, retirement. I'm going to briefly talk about this. This is something, I'd really recommend that you also meet with a financial advisor and your accountant to kind of look a little bit further, but I would much rather invest in my future than donate to the government, especially seeing how well they use our money. So there is a Roth and a traditional, and that's actually supposed to be IRA. That's a typo, not IRS, contribution limit. And it's the lesser of $5,500 or 100% of earned income. And you can make contributions until April 15th, 2017. So you can actually do your taxes, see what the bottom line is, and then decide what you want to contribute. So, there are different deduction limits based on your income as well. So make sure that you're, looking into that before you just, go ahead and contribute the full amount. And then you realize, I can't take the full amount. So do make sure that you learn those before you're just, sending checks. But do look into doing this because, this is going to help you in your future and also help the bottom line of your taxes in the current year. So, both are good. And then some other really important info. One, and this is a really important one, is the business form. Are you sole proprietor, LLC, corporation? Are you going to take the S-Corp election? These are things that you really want to talk to an attorney and a CPA about. You really want to talk to both. At the beginning, most times you're a sole proprietor, and that is completely normal. You really don't have a lot of income, so that's really all that's necessary. But as you're growing your business and you're becoming, more and more profitable and you're starting to make more and more money, you really want to look into either having an LLC or, a corp. And you want to look at the benefits of both and the drawbacks of both and what's going to be a fit. Each state has different rules, so it's not a blanket, this is what you do. So each person is a little bit different. In an LLC, are you going to have a single member? Or are you going to have you and your husband or you and your wife as joint, 50-50? What's that going to look like? And then when you have those, you also have to, figure out, who's going to file those returns, because most people don't know how to file an LLC, or partnership or a corporate return. So those are things you want to keep in mind. So as you're nearing, silver towards gold, you really want to look at, talking with attorney and CPA and looking at what are your options and what's going to be a best fit for you and your business. Like I said, it's not, always going to be the same. A lot of things go into play. Also, what's the other income in your household? What other tax things do you have that would come into play? So those are all things that you need to have when you're talking to your CPA and your attorney, because they're going to want to see all that and really give you the good advice.
Mm-hmm. This is something I should have done a lot sooner. So don't wait until, your diamond. That's when I set up my LLC. And this is another reason why this is a good time of year, because we did set up our LLC on January 1st of 2015, just to keep it very simple for records and taxes. So it was a nice way to do it. So we had the whole year to look at. But you can do it anytime. That was advice we had gotten. We did have an attorney set ours up. You will find there are places you can do it online and things, but you really need to know what you're doing. Get some advice from someone who's done this before. We had not done this before, and we wanted to make sure it was done right, both for legal, liability type protection and for tax purposes. We wanted kind of the best of both worlds, and our CPA and attorney did not necessarily agree at first on which would be best for us, because they were looking at it from different perspectives. The CPA was wanting us to get the most tax benefit, but the attorney was wanting us to get the most legal protection. And we were like, we want both, so let's have a compromise here. And we figured out what would work best for us with everything else coming into consideration. But I really kicked myself when I saw the difference it made in our taxes, and wished I had done it the year before. When I was going into 2014, I was silver, and then I hit gold and platinum that year. And if I had been set up for this that year, it would have helped me out a lot on what I paid for taxes for that year.
Yes, very good points. And things that you don't know without talking to someone.
Right.
Most people they don't know. And so it's just good to consult. It's not a lot of money to consult with an attorney and a CPA if they're able to help you out, especially, and save you a lot of money. It's really well spent money. So do take the time to sit down. And Crystal, I like the point that sometimes they're not going to agree, because we do look at them in a different perspective. I'm looking more at a tax standpoint, but an attorney is going to look at the legal. So you really do need to bring those together and really marry them to see what's going to be best for you and your family. So another important piece of advice would be to keep separate bank account for your business. This is really important. When you intermingle them and commingle them, it just is a mess. So keep them separate. Just get in the habit now of keeping them separate. So as your business grows, you're not having to change habits. And then I really recommend that you track your income and expenses somehow. You can do it as simple as an Excel spreadsheet. You could use QuickBooks or QuickBooks Online or Quicken. So there's, different things for different people, but find a way to track them. You can even use an old-fashioned pencil and paper and, have columns and do it that way, but just do something to keep track. So you're knowing where your business is. And we really should be able to know, like, yes, I'm making money in my business, or I'm losing money. And where is it that I'm losing money? Is it, is the networking profitable? Really start looking, so you can have a better eye for your business. Because yes, we can sell oils and we can lead people, but we also have to run a business. And it's a really key part of this business is actually being a good business person, a good business owner. You're the CEO of your business. And the CEO of, large corporations, they know what's going on in their business. They know their bottom line. They know, and they're constantly looking at, where, hey, is this, am I doing well here? What needs improved? So take time to do that in your business. It's really important.
Yeah. And you might want to ask, if you're going to work with a CPA, ask what they prefer. I know our CPA pretty much just tells people you can use QuickBooks and that's it. That's what I use. And it just keeps it easy for him. So we had to buy QuickBooks, but then we just give him the information on a jump drive. And it's really pretty inexpensive for us to use a professional when we have done all the categorizing and everything in the software that he prefers, versus, bringing in stacks of paper for him to go through. That just keeping track of it throughout the year will really help. And then I know a lot of people are using FreshBooks now, but again, for us, we're using what our CPA basically requires, which I think is great, because he just has to know one program and it works for him. So
right. And I've seen a lot of, different accounting programs, and QuickBooks is user friendly. So there's the desktop version like you use, and then you give him that flash drive. I also really like QuickBooks Online. It's a cloud-based QuickBooks, and you have a login. It is backed up by their cloud, so you don't have to worry about lots of data. You can get to it from any computer, anywhere you are. So I like the QuickBooks Online because you're always having the updated version. When you have a desktop version, like every year, QuickBooks updates. I don't recommend updating your software every year, but about every 2 to 3, they don't support the older version, so then you have to update. Yeah. So for big companies, not a big deal. If you're small, maybe you're growing your business, spending $300 on that software, or however, I don't even know at the moment how much QuickBooks is because I've used the online so much. But you have to continue that expense. So, but QuickBooks Online, there's different, monthly prices, so you can look into that of what's a fit for you as well. So I do recommend QuickBooks because most accountants know it, most accountants recommend it, and it's very easy to use.
Yeah, and keep in mind too that those expenses are deductible. So
100% deductible. So those are going to be things you would write off because those are for your business. And keep electronic copies of receipts if you can. Go paperless, but keep your receipts, and don't wait until tax time. I know we've said that a couple times, but it's really important. If you just put everything in a shoebox, there's a name for you in the accounting world, and we call you a shoebox client. And when we get the shoe boxes, we kind of all dread it because it's so much work. But when you do that, just remember, if you're going to an accountant that is charging you per the minute, because it's all billable hours, then you're paying them to do that. So if you're fine with that, obviously accountants do it, but it's a lot better for you too if you're not doing that. So just a little piece of advice. So that's all that I have. Crystal, my information is here. I do taxes during tax season as well. And so if anyone needs an accountant, I'd love to talk with you to see if it would be a good fit for you. And I don't charge by the hour. I actually charge by the form. So you know ahead of time what your costs are going to be. So here's my information if anyone is interested. And Crystal, do you have any other questions or comments?
No, just thank you so much. I would highly recommend getting in touch with Brenda. I should have done that a lot sooner and myself, but by the time I was ready to start using a professional, I also needed to figure out the laws for my state and, figuring out LLC and S Corp and all of these different things. So I needed to consult with someone local, but there's no reason that you have to use someone local to you, especially if you're just doing Schedule C. So I would highly recommend her. She definitely knows her stuff, and I really appreciate your time taking out the time to make this presentation and explain this to people. I think this is going to help all of us have something we can point our team members to. I'm sure you all learned something. I know I always learn something new from these presentations, but keep a hold of the link when I post that so you can share this with your new team members and they can get off on the right foot from the beginning in keeping their records and doing this the smart way. So appreciate it, Brenda. Thank you very much. And if you have questions also, we'll have the recording online and you can always post a question in the comments on the Facebook thread as well. And so I will be sharing this for November. There will be a giveaway for a drawing for one person who watches by the end of the month, but this will be available and helpful for any time. So thanks again, Brenda.
Thank you, Crystal. Appreciate it.